Welcome back to Get Paid for Your Pad. Today's guest is Kenny Bedwell. He's the founder and CEO, I believe, of STR Insights. And we are going to talk about analyzing properties today, analyzing short-term rental properties. Kenny is the #1 expert on that topic in the space. So I'm excited to talk to you, Kenny. Welcome to the show.
Thanks, Jasper. Thanks for having me on. And yes, STR Insights has not fired me yet, so I'm still the CEO.
All right. Well,
Yeah,
I hope they will fire you at some point so you can get some, vacations in and
yeah,
retirement.
seriously, yeah, some actual like breathing room. Yeah, for sure. Yeah,
You could pull a Steve Jobs and like get fired and then come back later and
yeah. There you go.
start another $100 million company in the meantime. And
Yeah, man. Yeah. No, that's yeah. No, but I'm excited to be on and excited to talk about short-term rentals.
yeah, 100%, man. Like, so we had you as a guest speaker in our mastermind a couple of weeks ago, I think it was, and that was like super insightful. Your whole process of analyzing short-term rental properties and really understanding at a high level, like how much potential is here with this property, based on like different comp sets and tiers that you look at, and then also, what can we turn it into? I thought that was really interesting. So I'm excited to dive into that a little bit more. But why don't you give us your background first and tell us a bit more about STR Insights?
Yeah, sure. So I have been investing in short-term rentals for over 6 years now. I have 6 properties myself, and I started STR Insights like 3 years ago as a actual way for me personally to identify the right markets to invest in based on my goals. So I came from I'm ex-corporate, worked at Citibank, data analyst, so data nerd, got a bunch of spreadsheets together, got a bunch of data. I was like, okay, what market should I go to? And that data took me there. And then I shared that with some of my investor friends. They were able to use it and they convinced me to quit my job and do a startup. So I don't know what was going on that night in my brain, but anyway, they convinced me to do that. So we were all together, gathered at a mastermind meeting, in fact, and they were like, Kenny, you need to do something with this and make this public. So I decided to take that leap. And I was already generating enough income from my short-term rentals to kind of have that comfort to walk away, or at least convince my wife that I could walk away and take a risk. And
That's the
so,
hardest part.
right, exactly, right. And so, anyway, so after that, I set out on a mission. I was like, you know what? If I can do this for me, and I've seen other people achieve this, why not help more people find profitable short-term rental deals? So that's the vision, that's the goal,
Mhm.
and that's what I'm set out to do, and that's what STR Insights is doing. So.
Yeah, and I think it's really important in the current climate to spend a lot of time on your due diligence before you buy a property and put it on Airbnb. I think there's a few people around that kind of learned that the hard way in the last couple of years, I think. So,
Yeah. It was funny. In 2018, 2019, I had no idea what a pro forma or like those calculators, you use for underwriting. I had no idea. I knew of them for certain types of, real estate investing. And then we obviously had them at the bank for underwriting loans and even just regular investing. But for short-term rentals, I had no idea really how to use it. It was just like kind of piecing some like, right. It was like, okay, what's this property going to make? And then can I exit as a long-term rental? Like, will that make enough sense? So I was underwriting everything as like a long-term rental. And then if that made sense, I'd consider it as a short-term rental. And so the times have changed. so where you really can't even do that anymore. And you really have to, I tell a lot of people are like, well, I want to find a deal like that where I can just, if I have to exit as a long-term rental, it's still going to make money. And I'm like, then it's not really going to be the greatest short-term rental. And if you're trying to be a short-term rental, go all in on that. And then you just need to make sure that you feel confident and comfortable in your numbers. So.
Mhm. So walk us through your process. Though you find a property on Zillow or whatever, wherever it is. What's your process for really analyzing that property and understanding is this going to be? Am I going to get a good ROI on this property, or not? Is it a good deal? Is it a bad deal? Kind of thing.
Yeah, yeah. So for me, trying to figure out if it's like a good deal or bad deal. So there's 3 things that go into underwriting. Number one, your gross revenue, which we'll probably spend the most time talking about that today. But then number two, understanding the debt service piece, because like interest rates, frankly, just kill everything now. You know, like 7%, 8% on some of these, especially the commercial products, 8% or more. It really just doesn't make sense for a lot of properties now. Whereas 2 years ago, 3 years ago, it was fine, you know? So we need to make sure that works. And then finally, the last one that a lot of people mess up on are expenses. So I hear it all the time. Oh, I forgot about this, or I didn't know I was going to have to do, you know, simple things. There's so many expenses. So we have those three pieces and we look at the full picture. That truly helps us know if it's a good deal when we underwrite it. However, the first one I always start with is gross revenue. So before I start looking for properties, before I start analyzing deals and diving into numbers and really trying to understand the markets, I sit down and go, okay, whether it's with someone I consult with or myself, what are my goals? What do I want to cash flow? What do I want my cash on cash goal to be? And then based off that, I'll determine a metric I use called gross ROI. So gross ROI is just your gross yearly revenue divided by the purchase price. So meaning if I find a property, for example, say my budget's $500,000 and my gross ROI target's 20%, meaning that 20% of 500,000 is $100,000. So if I find a property that grosses $100,000 at my budget of 500K, that means that no matter, you know, I'm sure I'm going to calculate all my expenses and look at the debt service and all these other pieces. But if it's 20%, there is an extremely high probability that that's going to be a really good deal for me based on my cash flow goals, right?
Right.
And so the important thing to take away from that, number one, is everybody's goal is going to be different. So Kenny's might be 20% and Jasper, you might be 22% or 23%, but it's going to depend based on the cash flow, your cash flow goal and your budget. And so we start with that in that gross ROI metric because I've never really, so like I'll set out and be like, okay, cool, my budget's 350 or, you know, some nice round pretty number, 500,000. But the property I buy is never 500,000. It's like 470 or 510 or something stupid like that, you know? And so I'll come out but when I use the gross ROI, I go, okay, cool. I just take 20% of that. And that's what my gross number needs to be. And if it doesn't hit that number, it's not going to make sense. I don't need to look at the expenses. I don't need to look at the debts. I don't need to look at anything else. It ain't going to make sense for me. So that's the first thing I start with.
Right. And just to dive a little deeper on that. So does the gross revenue, does that include the nightly rate and the cleaning fees and everything you would essentially like any net income that you would drive from the channels? Or is that just a nightly?
Yeah, it's a good question. So typically when I say gross revenue, I look at just the nightly rate. So I'll take, because I consider a cleaning, especially cleaning, is a separate line item in my pro forma or my underwriting process, meaning like it's income. The guest pays me that additionally, plus I have to expense it. So I consider it a pass through. So in all of my pro formas, I will say, okay, cool, $200 cleaning fee, or it doesn't really matter because I'm going to put it as an expense at the same amount too. So it cancels itself out. So I'll literally play with the nightly rate to get it to where I want to be. And then whatever the ADR is and the occupancy to get that nightly rate. So I'm looking at the gross yearly stuff.
Yeah. And then do you have kind of an understanding of, okay, if I can do 100,000 gross, excluding the fees, right? Excluding cleaning fees on a 500K property, do you roughly know what your net is going to be based off of that? Like you're probably going to, if you don't include the cleaning fees, then you're probably going to be, I don't know, maybe like 12 to 15% net based on that.
Of that? No. So typically what we'll see, well, I guess it depends on the debt service piece, but usually your profit should be about 30% of your gross revenue. So take out
right, but that includes the debt service, right?
Correct.
Includes, yeah, okay.
So
gotcha.
for example, if I have a good now, and there's some assumptions in this, but assuming the gross ROI, I've set the gross ROI metric, and I'm meeting my gross ROI. So a $500,000 property is generating 100K. Great. So if I take 30% of that, that means about $33,000 or $30,000 will be my profit, and that's usually what it comes out to in a pro forma.
Right. Okay. Gotcha. So
Yeah.
if you were to do a cash buy, then obviously that will be like a different picture. But essentially, you're saying like including debt service, you'd be left with about 30K on a $500,000 purchase. You would
Yeah.
finance it. You'd probably put 20% down, so you have 400K
Mhm.
of financing. So you put in 100K yourself. So then your return on your investment would be 30%.
Yeah, assuming I put in $100,000 into the deal. So yeah,
Right.
yeah.
That's pretty high. So you're shooting for a pretty juicy deal,
I
right?
mean, so okay, we'll back up a little bit. So a lot of people listening to this are like, okay, cool. I get this all the time because I use the 500 and 100 example. A lot of people are like, well, where are you seeing those type of deals? Number one, they do exist out there. They're just harder to find. We could talk about that a little later. But what am I personally going for? I don't care about the ROI percentage. I care about the cash flow. So I won't buy a property that doesn't cash flow $50,000. Okay, I don't
Mm-hmm.
care if it's only like a 20% cash on cash return or a 15% cash on cash return. If I'm going to cash flow $50,000, that is my goal because that's what my time is worth to me with
Mm-hmm.
running short-term rentals. So I've gotten rid of almost all of my properties that cash flow less than $50,000 because they're just not worth my time. And so I
Gotcha.
base everything off of that, and then my ROI goal will follow. So typically, but yes, normally I do look for kind of outrageous deals.
Yeah.
So, but
No, it's so
my
good.
minimum is all based on that cash flow number and my budget.
Yeah. All right. So you find the property, it's 500K. Now, how do you figure out if you can gross 100K on that?
Oh, all right. So
In
we're like
in 1 minute?
1 minute. Oh, geez. Okay.
No, just kidding.
Yeah, I'll break it down and then we can dive into each segment, I guess. So, the first thing I need to do is number one, I need to make sure I feel comfortable with the market revenue drivers. So, when I was with your group and we talked about this a lot, is understanding what drives revenue in those markets. So, a lot of us are used to just looking at deals on Zillow first or properties on Zillow first or Redfin, wherever the MLS, properties are looking at those and then trying to do the research behind it. But if we don't know what actually drives revenue in that market, then we're going to make a lot of assumptions and we're basically inviting a lot of risk into the deal analysis, meaning that we go, wow, this property, I just saw this really cool property that stands out to me because it has these really cool long range views. But the question you have to ask yourself, and sometimes it's really not as obvious as we think it is do long range views actually drive revenue? And then on top of that too, does that property have the same attributes as other properties that have those long range views? Because you might just assume that's it. So that if I know I've gone a minute already on that one, but a really good example of this is someone sent me a property in North Carolina, one of those weird. Have you seen those weird hexagon houses? They're octagon. They're like these weird. They almost look like yurts, but like huge. They're literally like 2,000 to 3,000 square feet, and they're houses, but they're in the shape of like a yurt almost. Okay, they're all over North Carolina. They're not super common, but they're common enough. I see them a lot there, and they're usually like in the mountain markets, and they always have like really nice views. However, when we look at the data and those using those as short-term rentals, they don't make that much money. And so, because they're just not like your typical house that someone would want, even though they have, it's large, it's got views. And so, one of my clients, she sent me one. She's like, Kenny, I looked at the market and I saw all the properties that were in the top, 75th percentile or whatever, all had long range views. And this one has long range views, therefore, it should make in the top 75th percentile or higher. And I said, okay, cool, let me check it out and validate that. So, sure enough, all the properties were there that had really the top ones had views. However, she stopped there. There's other revenue drivers. There's quality of the property, the furnishings, and the amenities. And so all those properties too also they were like log cabins. So not only did they have views, but they were all log cabins. And then the ones that weren't were making less. So when we look at the patterns and trends in the market, all the patterns and trends in the market, it tells us the full story. So I'd like to start there and then hunt for properties, or I'll start there and then go, okay, does the property I'm looking at have those same attributes as the ones that are making a lot of money in that market?
Mm-hmm. Yeah. And can you explain your tier process that you
Sure.
shared with us in the mastermind? I thought that was very insightful.
Right. So when I'm studying the market, the first thing I like, so you send me a property, I look at bedroom count, so then obviously how many bedrooms it has, and then I look at the market. Okay, so the market as a whole. I'll pull the data set. So our software STR Insights has, you can export all the market or all the properties with that bedroom count, and then what you'll see in the data set, if you sort by revenue, is you'll see groupings or clusters of properties by revenue. And I call these tiers. And so we saw this where we looked at a market, and there were 4 bedrooms in this mountain market in North Carolina, and the top one was doing like 175 and the bottom one was doing like 38,000. It's like, well, that's a wide difference. But as we studied these like tiered groupings, meaning like we saw like 38 to like 45, and then there was like a jump of properties, like nothing was doing between all the way up to like 60,000. It was like 60 to 75. And then like there was another grouping. It went all the way up to 175. So we looked at these groupings and we found that they had different attributes from one another. So the ones at the top, they had views and a pool. Then the next set had views. Then the next set had, they were really nice, but they didn't have any views. And the next set was like, okay, but maybe it had a hot tub, and it just kept going down. But it was really easy to like break it down black and white when we break it into groupings. And the data, to nerd out here, the data will tell us in most of these markets. So 90% of markets, you can see these clear cut groupings by bedroom count, and you can see what really drives revenue without having to guess and make the assumption that this is the thing that drives revenue, and I'm going to bank all that, my underwriting on that.
What are some of the biggest defining elements that will move a property from one tier to the next one?
Right. So it does depend on the market, but the 4 kind of categories I have. So location, quality of the property. So is the property updated? What's the interior, exterior quality like? Design and decor, so like the quality of your furnishings, and then finally amenities. But every market's unique. So
Yeah.
I've had people, and it's kind of crazy, the assumptions people make, where they'll go to a beach market and they'll take a property that's a mile away from the beach. And like the Outer Banks is a really good example. Most of the properties there are just like crap in terms of quality, but they're right on the beach and they're really good location. They make all this money. And someone will take a property that's a mile away and they'll fix it up, make it look really good, add the best furnishings, make it look better than the properties on the beach. And then they assume because it's of higher quality that people will want to stay there instead of stay on the beach at the crap hole, to say it lightly, And so it just doesn't work like that. That's not the market revenue driver. And so every market is different. And so we've got to understand what it is. So to get to another tier, we have to ask the question, number one, okay, is this property, if we're analyzing property and it's like in a tier 2 or tier 3, is it possible for it to be a tier 2 or tier 1 property? If yes, what does it need to have? Like, oh, well, we need to put it on stilts and move it to the beach. Okay, well, that's not possible, so that's not a deal, right? But if it could be just simply like it needs amenities, or it needs, in urban markets especially, just better design and decor. Those are things we can add to the property. Those are small investments. We call those value adds that we can add to increase the revenue and move it into a higher tier. And then the data set is supporting that like hypothesis or that theory that you have that it can move to a different tier. Instead of relying on 1 or 2 properties, you're relying on a whole data set to kind of back up your idea.
Yeah.
That removes so much risk from investing in short-term rentals because there's a lot.
Yeah.
So.
Yeah. No, I mean, it's pretty crazy to see the income, the revenue potential when you're like right on the beach versus literally like 1 block off the beach, right? Or when you're on the ski slope, or you're 200 yards away from the ski lift, right? I mean, it's huge. Like, we go skiing every year, right? And for me to be on the slope where in the morning I put on my gear and I'm I'm right on the slope. Go to the ski lift, and then when I come back in the afternoon, like I can go and grab a beer somewhere, and I don't have to worry about catching the bus or drive. I don't have to drive. I can just enjoy my time, see the sunset, have a couple drinks, and then I just ski down right to our house. Like that is worth so much money to me,
Yeah.
right?
Yeah, I
That
agree with
is
that.
worth
Yeah,
so much.
yeah, seriously. No, I mean
And to
that's
your point, like there you can make a pretty big investment mistake if you were look at a comp set and you're like, okay, well, let's look at this cluster of properties that are like within a radius of half a mile or something, and then you're like, oh, okay, well, they do on average X, and then you don't realize like, okay, yeah, but the properties that are right on the ski slope, they're doing like twice the amount, right? Versus couple blocks away, right? So like you have to really understand like those drivers and like how much revenue do you allocate to those drivers, and really understand that. And sometimes it can be like kind of unexpected things as well. You know what I mean? Like location, the view, like hot tub, pool, things like that. But I analyzed this little tiny little submarket in Lake Tahoe, and there was some sort of like HOA park that
mm,
certain properties people would have access to.
okay.
You know what I'm saying? So like there's certain properties where the owner had, I don't know, like a membership or something with that park, and then if you stay at a property you get access to that. And I noticed like there's a fairly significant difference in revenue for the properties that where you had access to the park and the properties that didn't have access to the park.
Right. Yeah, no, yeah, especially with the amenities. And I think but once again, you like you found like the data set provides kind of the answers. But if you're just kind of looking and not studying that market and looking for those like sweet spots in the market, and you're I call it flying over 30,000 feet, you're not going to catch that stuff. You won't.
Mm-hmm.
And
Yeah.
that's why people struggle to find deals.
Yeah.
So,
Yeah, it's like anything else. I mean, you need to spend a lot of time and effort to really dig through the details and really take your time to understand it very, very well. Before you can make these decisions. So, but especially now, right? I mean, like 5 years ago or 10 years ago, if you buy something in the city, pretty
yeah,
good chance you'll make good money on Airbnb.
right.
Not anymore.
Yeah, now you're just banned. Yeah, yeah, it's tough. It's definitely a transition the last few years. So,
Yeah. What are some of the biggest mistakes, like other than like not spending enough time to really understand the market? Like what are some other like common pitfalls or mistake that people make?
so a lot of people, I know a lot of people listening want to know if you're trying to find a deal. Okay, Kenny's been talking great numbers and process sounds really good, but how am I finding deals? And so the mistakes I see investors making who aren't able to find deals, there's really three. So number one, they're not looking in the right markets. Okay, a lot of people are attacking very saturated markets where everybody else is investing, or has invested for previous years, kind of run up on the prices there, and so they're looking in those places. Okay, number two, investors are not looking in enough markets. I run into this all the time where they're like, Kenny, I'm looking in the markets you told me to look into, or I'm looking into places, STR Insights or the data says go to, but I can't find any deals. And I ask them, okay, cool. Well, where are you looking? I'm looking in this tiny, ski market. It's like, great. What are the chances of the right property under the right conditions? Like it's a probability game. It's a numbers game, right? So and which leads to the third point, the biggest mistake too is deal flow. A lot of people who think finding a deal today should be easy and there's an easy button. There isn't. You have to look at enough properties. You have to evaluate. I tell people evaluate 8 to 10 properties a day. Not look at 8 to 10 properties on like, oh, Zillow, I scrolled, there's 8 to 10 properties. No, I'm talking about evaluate 8 to 10 properties that have potential to be good deals. Not all of them are going to be good deals. If you do that, you look in the right markets, you look in enough markets, and you evaluate 8 to 10, you will find a property in 21 days or less. Guarantee it. So and then enough markets, when I say that's five markets is my rule of thumb. So five
Hmm.
markets, five right markets, 8 to 10 deals a day, you will find something that makes sense in less than 3 weeks. So
But how much time would you spend on each property? Because like 8 to 10 sounds almost like a full-time job.
Right. But if you know what your gross ROI is, so if it's 20%, for example, that means you only need to know what the gross revenue is. And if you're studying those markets, you know what the tiers are. So you already kind of know what the revenue is when you see
Hmm.
these properties, right? So it's really just, okay, well, if this property is going to make, I think it's going to make somewhere between 80 to 80, 95 or 80 to 100,000. Okay, I'll take 80 and divide by the purchase price. Does that give me 20%? Yes or no? No. Okay, well, that's not a deal. So I'll go on to the next, it's like, and then we're
Hmm.
also just quickly trying to find properties that meet the attributes we're attacking. So if it's like, I need properties with views, well, I'm on Zillow, I'm only going to be looking at properties that have views. So, and you do this. So to me, if you spend 30 minutes if you can do an hour, that's great too. I think that's even better. So more time you can spend on it, better. But 30 minutes to an hour every day, 3 weeks, doing exactly what I just told
Hmm.
you will find a property in 3 weeks or
Yeah.
less. If you don't, it's a problem with one of those three things. So,
Right. Yeah, you can like if you're just kind of waiting for something to fall on your desk, kind of
or
thing. Then,
a realtor to send you a
oh
deal.
yeah,
That's a
right.
that's a common mistake. Oh well, I'm on their email list, and I'm like, cool. Yeah, how many people are on their email list? So, are you like? That's the thing too. I mean, a lot of the good deals that I get sent for my clients, um, it's the realtor will send it to me first, and they'll say, "Hey, do you have anybody you think is interested in this?" And it could be off market, but a lot of them aren't. They're like one day or like a few hours, or the realtor's listing it. And I'm like, yeah, hold
Hmm.
on, let me just blast this out real quick to my people, and because I know their situations, like I'm like, okay, this person could work. But we're able to quickly analyze and do that and act fast. But if you're just relying on emails, there's some generic services that blast out deals to thousands of people. Yeah, you're not going to find anything. So,
Yeah.
like it's just, yeah, if you just break down what you're currently doing, you should be able to see, like, okay, yeah, I'm either just not looking in the right places or I'm just not looking at enough properties. So,
Hmm. Yeah. Yeah. Makes sense. Awesome, man. Well, that's very useful info to have. I appreciate you coming on here and sharing this with us. What if people are interested in working with you or your tool STR Insights? What's the best place for them to go and connect with you?
yeah, absolutely. So number one, I am available on social media too. If you want to reach out and message me one on one, just at Kenny Bedwell on Instagram or Facebook. So feel free to hit me up there. But you can always go to strinsights.com. You can learn about the software. We also have the consulting services we do, is just strinsights.com/property finder, where we help people identify profitable short-term rental deals, because that's what we do. So, yeah.
Boom. Awesome, man. Any final thoughts before we wrap up?
Oh man, I always have final thoughts. I have a lot of thoughts. I could just, yeah, go on for days on this stuff. But yeah, the biggest thing though, I'll just recommendation, common mistakes I see people make and really mess up with underwriting and doing this whole process is always evaluate on a range. So we talked about earlier the tier system. So, or the ranges of revenue. Like, the fact of the matter is, when I underwrite a property, I don't go, it's going to make $100,000, because the probability of it making 100,000 is extremely low. It's either going to do above it or below it. Okay. So if that's the case, then we need to evaluate on a range. And typically, my rule of thumb, if you're like, okay, well, what's the range, Kenny? The tiers are dictating the range, but also you can use about a 20% too to be safe. But you want to look at it from a good, better, best scenario. Too many people are underwriting in the best scenario and they're not hitting that. So look at a good, better, best. It'll help you understand your risk. It'll help you and you'll feel more confident in the deal, in the decision making too, if it's a deal. So do that.
Mhm.
Just anything you take away from anything I've said, look at and run revenue on a range. So
Boom. That's it. That's
so,
it, guys. Listen to Kenny. All right,
yeah,
Kenny. Appreciate it, man. Thanks for jumping on here. I'm sure we'll bring you back in our mastermind. It was very fun to have you in our mastermind
I loved it.
and
You guys
literally
are
like analyze properties on the call live was
on the call.
amazing.
Yeah,
So
yeah, it was good.
all
It
right,
was
man.
really good. Yeah. So thanks, man.
Thanks. And thanks to all the listeners. Hope you enjoyed this episode. And we will be back soon, of course. We'll see you next time.